Hello and welcome to this Croner eCPD module prepared by Stephen Relf. In this module we will look at year-end tax planning for the company. Please note that we will be looking at the company only, not sole trader or partnership businesses. To begin, we'll look at how to plan an effective review, sketching out the steps you may want to take in dealing with your client. Next, we'll consider prior periods. For open periods, it may be that a claim or election could be made, varied or revoked to your client's advantage. We'll then look at issues to bear in mind with regard to the current year. The objective here is to spot opportunities to reduce the client's tax bill. Finally, we'll look ahead to the next period. It may be that steps could be taken now to reduce tax payable in the future, for example with regard to a proposed transaction. Please click on the buttons to find out more. The pre-year-end meeting is a good opportunity to look back at prior years and to establish if any actions need to be taken. First, are there any returns still to be submitted or tax payments still to be made? The deadline for submitting a tax return is 1 year after the end of the accounting period. This is referred to as the filing date for that return. In most cases, the payment date is 9 months and 1 day after the end of the period. If a deadline is missed, interest and penalties may be charged. Second, should a return that has been submitted be amended? The deadline for amending a return is generally 1 year from the filing date, or in other words, 2 years from the end of the accounting period. This ties in with the time limit for making, changing and revoking most claims and elections. For example, claims for capital allowances and R&D. However, a small number of claims and elections can be made outside of this 2-year period, and it is possible to make a late claim in some instances. We'll look at this in a later slide. There are a number of claims and elections which may be made outside of the usual 2-year window. The most common of these are shown on the slide. Section 455 tax is tax paid on a participator's overdrawn loan account. This is repayable once the loan is repaid. HMRC provides an online form for claiming repayment, and the URL for this is given in your notes. We'll look at Section 455 tax in more detail in a later slide. The time limit for making a claim for rollover relief is in most cases 4 years from the end of the accounting period. A longer than usual period is allowed because the company has 3 years after the disposal of the asset in which to buy a replacement. You may associate gift relief with individuals, but where it is used on the incorporation of a business, the company is required to make a joint election with the HMRC have a discretionary power to accept many types of late claims and elections. The procedure for making a late claim is set out in a statement of practice. It is stated that HMRC will accept a late claim where the claim was not made in time due to circumstances beyond the company's control. Some examples are given of circumstances considered to be beyond and those not beyond the company's control, and these are summarised on the slide. Do not lose heart where a claim is made late due to circumstances that are not beyond the company's control. HMRC will still accept a late claim in these circumstances where, and this is a quote from HMRC's guidance, it would clearly be unreasonable to refuse it. For the current year, consider if income could be deferred and expenditure accelerated within the accounting rules. Depending on the circumstances, this may give your client a cash flow saving. As the rate of corporation tax is set to reduce from 19% to 17% from April 2020, it may also be possible to reduce your client's overall tax bill. It is possible to make a provision in the company's accounts for the current period for a payment that will be made in a future period. The accounting rules allow this where there is a present legal or constructive obligation to pay an amount. That obligation results from a past event. It is probable that the business will have to pay it, and the sum can be estimated reliably. It is important that you fully document any provisions made so that they can be supported in the event of an HMRC inquiry. In most cases, the tax computations follow the accounts. However, special tax rules apply with regard to the timing of a deduction for some types of expenditure, and we'll look at these in detail on the next slide. Look out for these items when you prepare for the pre-year-end meeting. Could your client change their plans to stay on the right side of the rules? Pension contributions are deductible on a paid basis. This means that any contributions accrued for at the year end must be added back in calculating the company's taxable income for that year. Wages are deductible for the period provided they are paid within 9 months of the end of that period. In both cases, amounts that are added back for the current year are deductible in respect of the year during which they are paid. The next slide has an example of the tax treatment of staff. Interest paid by a close company to a participator in that company is subject to special rules. Briefly, interest paid for the current period is deductible for that period if it is paid within 12 months of the year end. Interest paid after that date is deductible on a paid basis. For capital allowance purposes, expenditure is incurred on the date that the company has an unconditional obligation to pay for it, generally the delivery date. However, there are exceptions to this general rule. For example, where the credit period given exceeds 4 months, in which case any expenditure paid after 4 months is taken into account by reference to the payment. Tax is payable under Section 455 where a loan to a participator is outstanding more than 9 months after the year end. The rate of tax is 32.5%. When the loan is repaid, the Section 455 tax is repayable 9 months and 1 day after the end of the period during which the loan was repaid. On a later slide, we'll look at an example to illustrate this. In this example, the company has an accounting profit of £450,000 for its accounting period ended 31st December 2018, after taking into account pension contributions of £23,000 and wages of £260,000. All amounts were paid before the year end with the exception of pension contributions of £3,000, which were paid in February 2019, and wages of £60,000. The accrued wages were paid as follows: £40,000 in July 2019 and £20,000 in October 2019. The company's taxable profits for the year ended 31st December 2018 are as shown on the slide. The accrued pension contributions of £3,000 are added back as they were paid after the year end. Of the accrued wages, the £20,000 not paid within 9 months of the year end is added back. Relief for both amounts will be available in calculating the company's taxable income for its year ended 31st December 2019. In this example, the company made a loan of £40,000 to a participator during its year ended 31st December 2017. Of that amount, £30,000 was outstanding 9 months after the end of the period, i.e. 30th September 2018. This gave rise to a Section 455 tax liability at 32.5% of £9,750. The tax was payable by 1st October 2018. The loan is repaid in full during the year ended 31st December 2019. The Section 455 tax is repayable to the company on 1st October 2020. The pre-year end meeting is a good opportunity to look ahead. Firstly, could your client do anything differently in the future that would save them tax? Some possible areas to consider are set out on the slide. Where an existing property is refurbished or a new property constructed, it is generally the case that some of the expenditure will qualify for capital allowances and some will not. Further, some of the qualifying expenditure may attract allowances at a different rate. Therefore, it is important that a detailed breakdown of the work done is provided. If your client has carried out this sort of work in the past and will do again, make sure they are aware of the benefits of providing detailed information. Another area to consider is motor vehicles. If your client regularly purchases vehicles, are they aware that the rate of relief can vary between different types of car and van? Choosing to buy a more energy efficient vehicle could give your client a cash flow advantage. Where your client claims tax reliefs, are their records such that no costs are missed? Further, could small changes in the way the activity is undertaken increase the amount of relief due? A good example is R&D tax relief, where good record keeping and a knowledge of the rules could mean a significant tax saving. For example, by keeping detailed timesheets, your client may be able to claim more of their salary costs. Detailed rules apply for R&D tax relief, with the result that not all costs qualify, and of those that do, different rates of relief can apply. Forewarned is forearmed. If your client is aware of the rules, they may make different decisions. It may be the case that recurring expenditure that is disallowable in one period could be allowable in the next if certain steps are taken. For example, where the company has disallowable expenditure in respect of gifts for clients, could the nature of the gift be changed so as to fall within the category of gifts that are allowable? Another good example is motor leasing costs, where there is a disallowance where the car has high CO2 emissions. Could a car with lower CO2 emissions be used in the future? The pre-year-end planning meeting is also a good opportunity for you to ask your client about their plans for the future. It may be that they are considering making a change to the business that will have significant tax implications. Possible changes include the following: buying new plant and machinery. You may wish to consider if capital allowances will be due, and if so, how will they be given? For example, will part or all of the annual investment allowance be available? Buying new premises. Capital allowances are relevant here, particularly where fixtures and fittings are involved. Will the new premises replace a current building? If so, you may need to consider whether a gain will arise on the disposal of the old premises, and if so, whether a claim for rollover relief should be made. Increased or reduced profits. An increase in profits may push the company into the quarterly payments on account system for corporation tax. Where the business is expected to make a loss, consider how relief for that loss could be obtained. Expanding overseas. You may need to consider if the company will have a permanent establishment overseas. If so, should the company consider electing into the branch exemption regime? The company may wish to set up a separate company to manage its overseas affairs. If so, will the company be UK resident? Selling or acquiring a business. Your client may be pondering an acquisition, or perhaps part or all of the business is to be sold. The way in which the transaction is structured can have significant tax implications. On a disposal, it may be that action taken now could increase your client's after-tax receipt further down the line. Finally, you may wish to use the meeting to update your client on recent and proposed changes to tax rules, rates and allowances. The slide includes some examples. First, there's the new structures and buildings allowance. This provides relief for capital expenditure incurred on or after 29th of October 2018 on new commercial structures and buildings. It is given at the rate of 2% per annum. Second, there are the changes in the amount of the annual investment allowance. This has increased on a temporary basis from £200,000 to £1 million. It will revert back to £200,000 from 1st January 2020. It is important that your client is aware of this if they are planning any significant capital expenditure in the near future. Third, we have a new relief for goodwill and related assets acquired on or after 1st of April 2019 as part of the acquisition of a business which also involves the acquisition of qualifying IP assets. Next, we have the reduction in the rate of corporation tax. This will fall from 19% to 17% from 1st April 2020. Finally, we have a proposed change. The government is consulting on imposing a cap on payable R&D tax credits for SMEs. The cap would apply by reference to the company's total PAYE and NIC's bill, and so is likely to be of most interest to companies engaged in R&D who use externally provided workers or subcontractors rather than their own staff. If the cap is enacted, it will apply from April 2020. Key things to remember from this module are: a pre-year-end meeting is a good way to learn more about your client's business and their plans for the future. Plan ahead to make the most of the meeting. This is also a good opportunity to look back at prior years. It may be that subsequent developments mean that a claim or election should be made, changed or revoked. For the current year, consider if any action could be taken to reduce your client's tax bill. Pay particular attention to the tax rules around the timing of a deduction for certain expenditure. Your client is likely to have some changes to the business in mind. These could have tax implications, and by planning ahead, tax could be saved. I trust you found this module on year-end tax planning for companies informative. Please exit this activity and click Launch Quiz to complete the quiz. Once you've completed the quiz, you'll be able to print out your personal certificate. The module homepage contains a link to the notes that accompany this module and to further resources available to you from Croner, including a Navigate Tax module dedicated to this topic. The module includes simple and clear guidance and a range of interactive resources, including a detailed claims and elections checklist. Goodbye. Thank you for using Croner eCPD.
For further information and to view the full range of Croner eCPD modules, visit our website at croner.co.uk.